To our discussions on the accounting standards. We have been discussing about the IFRS and the relevant international accounting standards. I will continue my discussion on the cash flow statement, which is IAS 7. We know that the cash flow statement IAS 7 says cash can be found in hand, can be found as a receipts minus payment, but more important, the accounting standard says classify these cash flows on the basis of operations, on the basis of investment and financing decision. So, in this session I would like to pick up one by one these decisions and discuss with some examples how to determine these cash flows. Let me start with cash from financing decision. Financing decision is raising money and repaying money, paying dividend and paying interest. So, therefore, cash from financing decision is the receipts from the financing decisions less the payments from the financing decision, and the cash from financing decision can be positive or can be negative. We'll see those items a bit later. Let us take an example to understand this cash flow statement. I'll use this example throughout our discussion. So, started business with 50,000, availed a loan of 10,000, 100,000, acquired plant for 50,000 on credit, purchased goods for cash 75,000, sold entire goods for 100,000, purchased furniture 35,000, interest paid and other expenses paid, except the plant. I am assuming all others are cash transactions. So, in a normal cash flow statement, as I mentioned, all the receipts minus all payments will give you the cash in hand. So, in this example, the capital, you have raised money, loans, you have raised money, there is a cash sale, that is 100,000. So, you are during this period you are raising 250,000 through loan, through capital and through sales, and the payments are purchased furniture, goods purchased, interest paid, and total payments is 95,000. So, you end up with 155,000. But IAS 7 says it is not enough to find cash flow statement like this. You have to classify this on the basis of the business decisions. Let us use this data to find CFF, CFI and CFO. So, CFF and CFI. As I mentioned, CFF is the decisions from the financing. So, in this example, you have raised capital 50,000, you have raised loan 100,000. So, there is an inflow due to financing decision 150 and you paid an interest of 10. So, there is a CFF, net cash flow from financing decision is 140,000. But if you observe under the investment decision, you have acquired the plant, but you have acquired the plant on credit. So, whereas you purchased the furniture too. So, in this case, so cash from investment decision is only purchase of furniture on cash or for cash. So, there is a cash from investment negative. So, there is a positive CFF and a negative CFI. Negative CFI means you are making investments. Now, let us see cash from operation. Your main operation is buying goods and selling. So, therefore, all the cash flows from that will be treated as CFO. In this example is 100,000 sales minus goods purchase, though there are expenses, but you have not paid for it. So, therefore, CFO is 50,000. So, cash flow statement that we have seen in a normally inflows minus outflows is 155,000, but however, as per IAS 7 it says it is better to classify them as CFF, CFI and CFO. So, this statement becomes more meaningful, useful and relevant for decision making. Let me pick up a very specific question here and issue here, that is CFO, cash from operation. CFO according to IAS 7 can be determined by using a direct method or by using indirect method. The direct method just receipts over payment, whereas indirect method is a profit plus minus adjustments. why is profit not same as CFO is in fact being answered by the indirect method. But to do that, you have to determine profit for this question. You have seen this information. So, for this information, first let us find the profit. The profit for this business is sales minus COGS minus interest minus expenses minus depreciation, that is a profit. But the CFO, as we have already seen, is a sales minus goods purchased 50,000. So, why is profit not same as CFO is a question which direct method cannot answer. The indirect method can answer that. So, what is this indirect method? Indirect method try to address adjust the profit with non-cash items, non-operating item and credit item. So, for example, in this case you have a profit of 20,000 which is straight coming from the income statement. You are adding back depreciation because it is non-cash, you are adding back interest because it is non-operating, you are adding back expenses because you have not paid. So, therefore, profit plus this adjustment gives you CFO. So, that means the profit of 20,000 is there, but your cash from operation is 50,000, which can be found with an indirect method or which can also be found with a direct method. However, the indirect method answers this question, why CFO not same as profit, whereas the direct method will tell you what are the cash inflows due to operations and what are the cash outflows out of operations. So, if I put them together, as I said, CFO is not equal to profit because of non-cash items like depreciation, amortization, non-operating items like interest and credit items like credit sales, credit expenses, credit purchases. To summarize, therefore, cash flow statement can be determined as a receipts minus payment, or cash flow statement usually recommended to be determined as CFO, CFI and CFF. Thank you very much.